Hello, everyone. Welcome to our quarterly housing market update. My name is RAlbert. I'm a real estate broker associate with America Real Estate, as well as a house hacking investor here in Los Angeles. And with me, as always, is Mr. Jon Kim. Why don't you go ahead and introduce yourself?
I'm Jon Kim, NMLS 1509487 with guaranteed rate, and happy to be here.
Cool. All right. So for those who have watched these episodes in the past, the drill is we ask each other questions about what's going on in the market. And then there's a couple just general discussion points that we had that we've been seeing. And then, you can go ahead and comment below wherever you're watching this, ask more questions. We're happy to answer them for you. So why don't we kind of jump into it? Redfin, as part of their top 10 predictions for 2022, said that interest rates were expected to go up to probably around 3.6 or so. A lot of the other experts were saying the same thing. What the hell happened? I mean, we're in the fives. So can you kind of touch base on why did they go up so fast? Why is it higher than what people predicted?
Yeah, I think at the end of the day, there's kind of a very simple answer, and then there's kind of like a very long, complicated answer, but I can help that with a really cool metaphor that I learned. So for the majority of the population, the very simple answer is inflation. Inflation is at 8.5%. It's the highest it's been in 40 years since the early 1980s. And that's just driving things to be more expensive, including mortgages. And that's really the layman's terms of exactly what's going on, and that's all you really need to know. But if you kind of want to really deep down understand how this all works, right? This wasn't my idea. I learned this from a professor, and it was super cool. That's the only thing I remember from that class. So here we go. Imagine the economy is a semi-truck trailer, okay? Imagine the speed of that truck trailer is inflation. Imagine the driver of that truck is the Fed, Colin Powell. He's the truck driver with a big, hat on right now, big red, trucker hat, okay? The road you're going down, right? The road that was behind you is what happened in the past in terms of what the economic situation was. The road to the front of you is what's going to happen in the future, okay? Now imagine this. Imagine you're Powell, the Fed chair, but the problem is that you're driving that truck backwards. You can only see the road that happened behind you, not in front of you. And the economic tools that the monetary policy tools that the Fed uses to control the economy is like your steering wheel, your clutch, and your brakes. Okay. Now imagine not only you're facing backwards, but you're also delayed in reaction and response time every time you push on the brakes or change the steering wheel. Okay. So what does that basically mean? It means what the Fed is trying to do is they're trying to control the speed of that semi-tractor trailer. And then they have no idea where that road is going to go. They can only look in the past road and see where they've gone. They kind of adjust. Okay. But that adjustment is going to take time, like 3 to 6 months for them to see what the response is in the economy. So what's going on right now is that truck, the economy, is going at like 200 miles per hour. So imagine the semi-trailer is going down this road at 200 miles per hour, and you have no idea what's in front of you, okay? You can only make predictions based upon what's behind you, okay? So they're in a very tight spot right now. Now, inflation is at 8.5%, which represents the 200 miles it's going. And you basically have two major problems. The first is if you do these things to slow down the economy, like you offload your balance sheet, basically meaning you reduce your debt, right? You raise short-term interest rates, which is the rates that banks use overnight to sell to one another. You raise those rates. What you're effectively doing is you're putting a brake on the economy, okay? And you're slowing that truck down. Now, the problem is that, imagine this. If you put that brake on too fast, then you jackknife that trailer, and then it rolls off the road. Okay. The other problem is the opposite extreme problem is that 200 mile per hour trailer is going, and that you have to do something. But if you don't do anything and you don't do it enough, it's going to go to 250 and it's going to go to 300 miles per hour. And pretty soon that road that you can't see, you're going to hit a bend, and then you're going to crash too. Right. So the Fed has this you know, balance that they have to do to make sure that they slow down the economy enough to make sure that that economy is not going full steam ahead, but not so much as to cause us a recession. Okay, so because of that, what they're trying to do is raise those rates, and raising those rates effectively will slow down the economy, make sure people aren't borrowing as much, and then kind of put the jets back off from the economy. So that's kind of like in a nutshell what's going on right now. And things like China and Shanghai with their COVID lockdown, zero COVID policy, things like that. The supply chains are all messed up. And the thing that the Fed cannot control, which is like the gravel in the road, they can't fix supply chains. Like that's not their deal, right? So, there's real problems with supply chains right now. And that's something they can't fix. And this entire time in the past COVID years, they've always been saying inflation's been transitory. It's going to fix itself. But so far it hasn't. And that's why, those companies have probably said, we don't think that it's going to get out of control in terms of rates. But what they're trying to do now is instead of raising a quarter, which is typical, they're the next meeting in May they might raise it by a half a basis point. So there should be like a total of 7 rate hikes this year, and then maybe like 3 or 4 next year. But nobody really knows, right? But the good news is that since January, I feel like rates have stayed pretty steady. They touched up in the mid fives or around there right now, but they're not getting out of control because the market has already kind of factored in everything that Powell was saying. And this has happened before, like in the 90s, this has happened. And before, the communication with the Fed wasn't nearly as transparent as it is today. So the stock markets can kind of react and be proactive about it.
Right. So, I mean, basically, the Fed's raising the interest rates to slow everything down.
Correct.
They're doing it because some might argue it's actually out of control. Like from when homes are appreciating as fast as they are, that's great if you own property. But if you're trying to buy, the issue is you cannot catch up.
Yeah, exactly. So like pre-approvals that were based upon a certain interest rate back in December, at 4.5, something like that. Sometimes if you were on the cusp, like you were at the very cusp of what you could afford, it could knock you out of the price that you think you were going to get.
Mm-hmm.
So there's solutions to that problem, but at the end of the day, people are getting, the same thing for a more expensive price, and that's including everything: gas, groceries, a home loan. Same thing with that too.
Got it. And that makes sense. So then what are the next steps for home buyers, right? Now that their budgets have been basically thrown all out of whack.
Yeah, so the thing about it is in the 90s we ran into the same thing, this kind of the exact same situation, and the data showed was that home prices didn't really go down. And it also showed like in 93 was that sales decreased a bit, but people can't stop really buying homes, right?
They still need a roof over their head.
You still need a roof over your head, exactly. And especially in the LA market, it's always competitive, okay? So if the question is like, do you want to time the market and wait? I think that's a very bad idea in my personal opinion, because as you wait, we know that there's going to be at least 6 more hikes this year, at least 4 more next year, barring something tragic happening in the United States, right? Which
Mm-hmm.
God forbid that doesn't happen, right? But it's just time is expensive, right? So the longer you wait, the more it's gonna. I don't see it turning down anytime soon in terms of prices or rates.
It's interesting you bring that up because I was just talking to someone literally yesterday where they were looking to buy. Then they're like, you know what? I think we're going to hold off for 2 years. And I said, okay, that's your choice. I'm not going to force you to do something you don't want to do. But something to think about is if you're paying rent, right? Let's say $3,000 a month. Well, that's $36,000 a year. If you wait 2 years, that's $72,000 with nothing to show for it. So to your point, if you buy something today, and then 2 years later, forget let's say the value stayed the same, you built 2 years worth of equity.
Yeah, absolutely. So, equity is built in 2 ways. Is one, you make your monthly mortgage payment, a little bit it goes to principal, most of it goes to interest in the very beginning, but then that switches in 15 years into it basically. But also just the regular market. So if you lived in anywhere but Los Angeles, It might be shaky as to whether or not you see whether or not there's going to be appreciation, year on year end over year end. But, in general, I would say that everybody if I've ever talked to or anybody who's in the market knows that prices aren't really coming down at all. And as time goes by, like you said, building that equity is key because especially if you're a first-time home buyer, that equity is what you're going to use to buy the next home. And in the United States, people's wealth is usually from the real estate asset that they own by far more than anything else that they do own.
And chances are this is, I was actually listening to a podcast just yesterday where they were talking to a big panel. And the thought is with interest rates going up, so does rent. That all inflates with it. So it's not like, oh, I can stay put in rent for a while. It's no, rents are going to go up. So if you lock in a fixed rate with your mortgage, that's under control. That's how you beat inflation, is keeping your costs the same or lower. But you can't do that if you're renting.
Exactly. And, you got to think that, just time is money, right? Like if you don't have the ability to, get the down payment or whatever it may be, you got to save up. You can ask for gifts. You can get cosigners. There's lots of different ways. There's no shame in it whatsoever, right?
Especially here in LA. I sorry to interrupt, but that actually happened to me once recently where actually this was a while back, and he's like, my parents are going to help me, but like he seemed kind of embarrassed, and I
Yeah.
was like, you do know that's super common.
Oh,
Like,
yeah.
there's nothing wrong with that. Your
Nothing
family's
wrong with it.
basically saying, hey, we want you to be successful. We're here to help. Otherwise, they would just let you rent.
Exactly. And, I would say maybe at every 10 files I see, maybe there's like, on average, like 3 to 4 are getting gifts. It's not, I mean, people who don't need gifts are people who own homes, which
That
is the
is
irony.
okay. Hey, look, I used a line of credit for my first property to help buy the second one. So you're right. I used my property that I owned to buy the next one.
100%. Yeah. Because over time, the equity that you put into it just by making your payment is going to build. And you don't even have to think about it, right? It's just like paying rent, except that rent is being diverted, quote unquote, to your principal, a little bit and then a little bit to your interest. So,
Mhm.
without you even thinking about it, you're building that equity. Um, first time home buyers are in a very specific situation in this modern economy where nobody really has to face the kind of conditions that people are facing right now. It's hard. It's tough. It's not easy,
Yeah.
especially in LA because prices are so high.
Yeah, I totally agree. I mean, we all kind of like laugh because, I bought my condo for one price, but that was also in 2015. But at the
Exactly.
time, it was expensive. It's somewhat relative, but yeah, it is getting perceivably harder. So you just have to get more creative, but people are doing it.
And what we have to really, put in a retrospect here too is that, a rate of 5.5% in the long run of, since we've been doing mortgages in this country is still historically low. So 1986 was the highest it was at 16%.
I think we're
Um,
happy to buy.
you're happy to be there, exactly. So, you may have not caught that perfect moment, when it was at like below 3, but you're still in a really good position, and not to be like negative, but it's only going to get worse from here on out.
Right. And it's interesting. I was talking to my dad and stepmother the other night, and when they were talking, they mentioned interest rates. And they're like, well, it's getting so high. So I said, Dad, when you bought your first property, what was your interest rate? And he's like, I think around 6%. I'm like, there you
Exactly.
go. Like, it almost feels like we're now getting back to the new normal. I think people were just so spoiled with these low interest rates that they didn't realize that over history, this is almost like it was an anomaly.
Yeah, and everybody's beating up the chairman because
Of course
they've
they are.
injected
He's costing them money.
absolutely they've injected so much money during the pandemic that it's just been the way business has been for the past 2 years. We have very short memories, and this transitory inflation that they've been touting this entire time is proven to be not so transitory whatsoever. So yeah, nobody's happy about it.
Right. Yeah,
But
it makes our lives actually more difficult in a lot of ways.
100%. Yep. Because now we have to readjust. We have to tell. I mean, sometimes if they're knocked out, you say, okay, you got to readjust back down from 800 to 700,000 because of this issue, something like that.
Yeah.
Absolutely.
Yeah. It's almost like I have to do a review of all my clients and say, we have to start over. I mean, in a
Exactly.
lot of ways, it's like, hey, we need you to reach out to Jon Kim because we need to readjust what you're actually qualified for.
Yeah.
Yeah.
And like that going back is sometimes harder, I feel like, than just doing it right the first time, right? Because
Mhm.
it's all fresh data, fresh credit report. You know exactly what's going on at the time, but then 6 months later, your credit report's expired, your pay stubs are different, your bank account's different, and then it gets kind of it not fun,
Yeah.
not the fun part of
And
your
I think
job.
the ones that are probably also really struggling are people who've been, I've had clients that take 6 to 8 months to buy something. It's not like they haven't been active. It's not like they haven't been writing offers. So it's like, I feel for them because if they start looking in December or November and they have been active, now they've been knocked out or they just have to readjust. I shouldn't say knocked out, right? And we'll talk about that later on why they're not necessarily knocked out of the market. But just in general, it's like they are trying to buy a house. It wasn't like they've been waiting.
Yeah, yeah, because the market supply has been so tight, and you know more about that than I do for sure. But that's not helping anything either.
Yeah. So then let's kind of touch base on the clients that already own their homes, right? So one of the things that I really like that you do is you'll send out an email saying happy mortgage versary. Um, and it does spark that conversation. Like with one of our clients, they just sent out that email last year, they bought. And so I reached out and said, look, it's not going to be worth refinancing, but is it worth visiting your private mortgage insurance?
Yeah, absolutely.
All that. So now he actually called me and we started that conversation. So are you seeing, are there any thoughts on the cash out refinancers or just refinances in general versus HELOCs, which are home equity lines of credit? It's like a second loan, that sort of deal.
Yeah, actually, I would say rate term refinances, unless it's like an investment property, have pretty much fallen off a cliff. I think the statistic is this time last year, it's like 60% less volume than it was before. And, to put that in perspective, though, the last 2 years have just been record breaking in terms of it almost broke the industry down because there wasn't enough money to lend because the Fed had to jump in because everybody was refinancing, right? So it's not like it's this huge plummet from the normal. It was a huge plummet from the extraordinary. But yeah, if they are doing a refi, it is going to be a HELOC. It is more than likely going to be a cash out. We see a lot of entertainment people do cash outs. Now, I'm not exactly sure what they're doing, or they're trying to fund like the next project that they're trying to work on. But yeah, you're exactly right. I've got HELOCs going on right now, and very large HELOCs. The HELOC going on right now is like 200K. I'm like, wow, that's a huge HELOC. Normally it's like 50, 80K, but it's a big one. He didn't want to touch it his first because his rate was so low because he refinanced during the crisis. So
And
absolutely,
I've had a lot of people ask me about that. And like, should I do a cash out refinance? And it's like, why?
yeah,
Like, do the line of credit because then for a short period of time, you're only paying interest on the money you pulled out. So to your point, it's like, okay, I can pull out 200,000 in a line of credit. Doesn't mean I have to use the full 200,000, but it gives me
exactly.
that leverage. If you do a full on cash out refinance, the money's out. You're going to be paying interest on it, whether you pay it off or not.
Yeah, and the second thing too is, if you have a very large first, you know, if you pay a higher, even like even though a HELOC is going to command a higher rate than your first,
Mm-hmm.
because it's a smaller loan amount, it's going to be probably cheaper for you in the long run if your rate's pretty decent. If it's below 5.5 right now, then you should probably just stay put.
Got it. So it's almost like the blended rate. If the
Totally.
blended
Yeah.
rate is less than if you did a cash out refinance, do the line of credit.
Absolutely, yeah. Cash out is going to be one of the more expensive of your transactions. It's probably going to be the most expensive, actually. The most expensive of all will be a cash out on an investment property. That's the riskiest in what banks think of.
Mhm.
Um, Cash out on your primary is, it's a little bit of risk, but a
Depending
rate
on your
term,
financial position.
exactly.
Yeah, I had a client, this was 2 years ago because interest rates were so low. he pulled out, he did a cash out refinance, pulled out 50,000 and his payments actually went down.
Yeah, that can
But
happen
those
too.
days as of today are gone.
Yes. Yeah, they're long gone. I don't think they're coming back for a while. Not in our lifetime.
That's fair. That's fair. So you mentioned investors. How are investors faring right now from a mortgage perspective?
Everybody's super defensive, I feel like. It's because, banks hold notes and those notes become invaluable when the markets are increasing, the rate and the interest rates are increasing, all the rates, 10-year, the 2-year, all that stuff. But the stock market has a reputation of just going out of control, but it usually settles back down once everybody has some kind of normalcy to it. And I feel like at this point, it's pretty steady, right? If there's one thing, that maybe you can't fault the chairman for is that, communication, it's pretty regular. We get communication all the time and all the unemployment job reports and then, non-farm payroll reports and things like that. Unemployment, that data comes out and it's all free, which is why it's great to be in the United States because of, free information, so that people can make educated decisions on a free market. But I think people are preparing, they're preparing to make sure that, the that they're protected in the future as if rates increase now. But yeah, I mean, even what's on a different note, people who are trying to get those alternative income loans, like no doc loans, those ones are not faring very good. Sometimes they didn't honor locks that you locked in like 60 days ago, and they'll find a reason for you not to fund that loan because they'll go bankrupt because that's just all private money kind of thing. Those people are faring, I feel, a lot worse.
Got it. That makes sense. It was interesting. I was listening to some experts, and they were saying, from an investor perspective, it's actually a good thing that interest rates are going up because the problem is there was so much volatility in the market that as an investor, right, the whole point is to lower your risk. But with the values going all over the place, it makes some investors feel uneasy. So by slowing down the market, by raising interest rates, it creates a more predictable market.
Yeah, and even on your side too, right? Is that the people who just were not serious because the market was so good and the rates were so low, that you just had a lot of tire kickers just putting offers in like 5 different houses at the same time. Some of them were legitimate; they just wanted any house they could get.
Sure.
But a lot of them just were not serious. They would release all their contingencies up front, and then they'd back out as soon as their offer was accepted, right? So there is an upside to it too that now the pool of people, the pool of buyers are going to be limited to the ones who are serious, who are going to go through. You're going to have probably less cancellations. That I would have to believe. Is that kind of what you're seeing on your end?
A little bit. So yes, the market is going to slow down. So my last listing, we actually did price it aggressive on the high side. I was like, look, here's what the comps are. Now all of a sudden a neighbor put their home on the market. We got to go higher because it's like, it would be hard for me. We still got 2 offers, still sold for just over asking.
Nice.
But it wasn't like we got the 30 offers that we used to.
Right, and that can be more of a hindrance than anything else too. Like that can be a major.
It makes my job easier.
Yeah, absolutely.
It's funny because some agents will argue that if you're getting 30 offers, it means you actually did something wrong. It means you priced it too low.
Too low, yeah.
Right?
100%.
But it's also one of those things where back when the interest rates were low or there was just a more buyer frenzy, you almost could have priced your home within reason at almost any price, and you were going to get action.
Mm-hmm.
Now buyers are second guessing it.
Yeah, like psychological studies show that like too many choices of like the type of cereal that you want to get actually makes you not want to buy it at all because there's just too much for you to choose
information
from.
Overload.
Exactly.
Yeah. So, from the multiple offer standpoint, I think that we're going to see a shift depending on neighborhoods, right? Because one of the big things with rising interest rates or rising prices, the competitive advantage that Los Angeles or Southern California has is we have different neighborhoods at different price points. So if someone can't afford Granada Hills, they can go to Mission Hills, and that's right next door. If someone couldn't afford Beverly Hills, they can go to the Hollywood Hills or go to Westwood. Like there's buyers have options where they might struggle as places in the Midwest where it's like, hey, look, most of the neighborhoods are all the same price. So if you can't afford it, you've just been knocked out totally. Here, buyers can shift, right? We have a client we just closed with them the week before, so 2 weeks ago in Palmdale, right?
Yeah.
Because the market in LA was so saturated, it was so hot and competitive, but we went out to Palmdale where there aren't as many, there's choices for neighborhoods. And our client, multiple offers, but still got it for below list price.
Nice. Yeah.
Right.
Absolutely.
So we have the ability to shift. And I think that's what's probably going to happen. We're seeing a lot in Ventura County. So my listing was in Simi Valley. I had 60 parties through both Saturday and Sunday. I didn't necessarily tally it up, but I'm going to say 75% of the serious buyers all came from the Valley, San Fernando Valley.
Yeah.
Two offers we got, one was from Glendale, one was from Van Nuys. So
Right.
they just know that they can go there and get way more for their money.
Yeah, thank goodness. Like what you're saying too is that this isn't like San Francisco, right? Where San Francisco, you have this little peninsula that you have to work with,
Right.
and then you have to drive like 2 hours out in order to get something decent. That's still like
Right.
$1 million. Yeah.
Yeah. Oh yeah. And that's exactly right. You know, I look at home values in the Bay Area on occasion. I have some family up there. So I'm always kind of curious because that's just what we nerds do. And you're right. It's like I'm looking at all these neighborhoods where growing up, so I grew up in the Bay Area. It's like we would never live here.
Yeah.
And here's a home going for like LA is considered a steal in comparison to the Bay Area.
Definitely.
You know, so and then we see a lot of that. So if buyers from New York or San Francisco, they get priced out, they might actually move to LA because they can get a similar experience, right? The city with the restaurants, the activities, but arguably for a cheaper price.
Yeah, absolutely. Compared to New York, I mean, that's just
Mm-hmm.
ridiculous. Yeah,
Yeah.
absolutely.
The price of a studio apartment in New York could be a house here.
Absolutely.
And if you're trying to raise a family and we have better weather and we still have LAX, right? For flights. Like I always joke with my family that live in the Midwest because it's cheaper for me to fly to Europe than it is to go visit them. So it's like, I'm sorry, I'm going to Spain. Like I
Yeah.
love you, but
Yeah.
so what do you see going on kind of like the back end as a loan officer from a mortgage industry standpoint? What are you seeing? Is your job
Um,
harder? Is it getting easier?
it got a lot easier in one aspect was self-employed. Self-employed during COVID was just phenomenally difficult. The Fannie Mae and Freddie Mac put in additional requirements for self-employed people to make sure that their income was stable basically to the day you fund. You had to provide a profit and loss. And, some people are just small business owners. They don't do profit and losses. Your latest 3 months bank statements was what you needed. It was very difficult. And people who would normally have a no problem, who don't show like a deposit for a month, they're just knocked out. Um, and then you have to wait maybe another month. But by that time, because, COVID, with the market was so crazy, you might not have that opportunity. Now they lifted those restrictions. It's back to normal. People who are do their tax returns as a sole proprietor, which is a Schedule C in your tax return, whatever income is on that number is the income we use now, which is what the way it was always. Now we understand why it happened, right? Is they wanted to make sure that they avoided an '08 recession crisis, making sure self-employed people are able to pay back the loan that you're giving them. That's fine, but there's a point when I felt like it was just phenomenally difficult to get a loan through on top of a normally phenomenal difficulty even during normal times. At that time, even jumbo loans were easier to get through than regular conforming loans, which was
Hmm.
nuts. Um, but yeah, I would say though that everybody's returning normal to the normal standard. So in terms of the the nuances of it all, it's back to normal, which is really good, which is really nice. With all these new standards, I felt like lenders were kind of a little gun shy, right?
Hmm.
Because they were afraid they're going to make a mistake because everything was changing so fast and so rapidly. Um, but at the end of the day, like, we're going to be entering our summer season. It's going to get a lot busier here. And typically, mortgage companies, they downsize during the winter months because activity is very slow. Now they got to pick it back up and ramp it back up. So you're going to see a lot more activity, and this is the time when, the activity is increasing. They're going to have to, increase their workforce, and, they're not, and you can't just hire somebody off the streets and do a loan, right? There's lots that goes into it. So, you have to have trained people to do that as well.
Are you seeing delays in terms of purchases, refinances, or is everyone able to pretty much stay on schedule? Because I know appraisers sometimes are getting backlogged, but maybe I'm wrong.
Okay, so that's a great question, really good question. I would say, like, on the normal side loans, I don't see a real backup at all. But on the niche loans, that's where I see a lot of backups. Not so much on the appraisal side. It's much more on kind of the underwriting side, because those niche banks that do like cross collateral loans or departing residence loans or bank statement loans, things like that, they don't have this depth of underwriters. They don't have like the third and fourth string out there, right? So they are getting super backlogged. Um, but for your appraisers, 14 days is probably still pretty normal, I think, to get an appraisal back. I don't think that's kind of out of the realm of possibility. I just had one where I had to get an appraisal, and then came in like day 10, but then there was a mistake, and we had to get it back to the appraiser for him to fix in order to get back to the investor for them to approve. My contingency was up on day 14. It came back on day 14 corrected. It was like, oh,
Is that
thank
where
the
all your
Lord.
hair went?
Yeah. Oh man. Yeah, because everybody was like, you gotta lift it. You gotta lift it. So, there's a lot of pressure on us to lift contingencies out according to the purchase contract timeline. So, even in that scenario, we were able to get it back in 14 days corrected. Um, but on the flip side, one of the niche lenders that I wanted to use, for the same deal, it was a 30-day close of escrow. Guess how long they said it would be before they were able to touch it?
45.
31 days.
How many?
31.
Oh, wow.
Yeah. I was like, that's not going to work. And they're like, you're right. And they're like, we want to tell you this up front because, we don't want you to be unpleasantly surprised. Like, we get paid, when the loan closes too. Like, we don't want to, turn away loans, but this is the reality of it. Um, so, so yeah, yes and no. So I would say the majority of loans is not a problem. It's only the niche ones, that are a problem.
I wonder if it makes more sense. And I've been hearing that some lenders do it, but it'd be interesting to have like on the back end a night shift and a day shift.
Yeah,
You
like
guys can be
manufacturing.
processing literally 24/7.
Yeah.
And then that way, like you have a night shift working on the loan. Then in the morning, you get an email, hey, here's everything I need. But this way, like the pipeline actually literally never stops.
Yeah, when I was in manufacturing, I was in aerospace manufacturing. That's what we had, three shifts all the time, always
Right.
going. You have a pass down communication. Yeah, it would be a lot more efficient for sure.
Yeah, it's almost like I mean, fine, you're right. It's you're manufacturing loans. So treat it like a plant.
Absolutely. Yeah, it's no different.
Yeah.
Any operational process, no matter if you're doing loans or manufacturing, that's it's all the same. But no, but Gavin Newsom might have a problem with that if they're going to go to a 4-day work week, though.
Fair point. Fair
Yeah.
point. So those are the questions I have because there's a couple of like discussion topics for us. So why don't we go into your questions for me? Because we've already
Yeah.
answered some of the other ones I had.
So it's always the same question because it always changes. What's the general health of the LA real estate market? What are you seeing that's going on out there?
So it's actually really hard to tell because interest rates just, keep going up, right? So generally speaking, the market's still very strong, right? So the month supply is when, if no new homes came to the market, how long would it take for everything to sell? So right now for LA County, we are at about 1.4 months. So anything below 6 months is considered to be a seller's market. Anything above 6 months is considered to be a buyer's market, right? Because it means there's so much inventory. So with only 1.4 months, that means a month and a half, and the entire inventory is wiped out.
Right.
Ventura County is at 1.2 months. It's even less. And a lot of this has to do with it's all about inventory. There's not enough homes on the market. And, my guess is it's probably going to stay that way for a while, right? Because as you mentioned earlier, people refinance with such low interest rates, they almost can't move.
Right.
They're locked in. Why would they sell their house to effectively, for the same price, buy another house that's actually just going to be more expensive? So,
Absolutely.
and then in that case, you're right. Maybe HELOCs might become a popular thing because if someone's like, I need a fourth bedroom, it would be cheaper for them to stay put and do an addition than it would be for them to go try to buy another house.
Right.
So yes, we are still seeing very low inventory, and that's going to play a factor into the housing market in terms of prices, in terms of competition. Yeah, we are probably going to see, not as many offers. I think also, at least in my experience and what we're seeing is buyers are pushing back. So, buyers are pushing back like, no, I get it. The market's hot. There's low inventory. This house needs too much work for me. I'm not going to take a gamble. Or, hey, look, you're listing your condo for $550, but a couple doors down, one just sold for $485. What makes you think I'm going to pay that price?
Mm-hmm.
Right. So buyers are getting smarter. Not that they weren't smart before, but they're not in that desperation mode. Like
Right.
they're willing to wait it out if it means not having to overpay for a property. With that said, in general, for LA County, homes are still selling for over list price. Right. So I think LA County is about 104%. That's what I have in front of me. Yeah, 104.3%. Ventura County is about 103.4. So we'll call it about the same. So for the majority of buyers and sellers, they are paying at list price or above for the most part. I think where we will start seeing exceptions is on the investor side because interest rates have gone up. Therefore, they can't offer as much because it's not like the rents have skyrocketed as much as well. But generally speaking, we are seeing a push on the rents. Like rents, I know for one of my rentals, rents are up about 20 to 25%
Wow.
in the
Really?
last couple of years. Yeah. I mean, so we have a lot of landlords that were burned during COVID and frankly, they've been ignored. Like, yes, there's a rent relief program. Not all of them qualified. You have tenants that could have said, cough, cough, COVID, and I don't have to pay. A lot of that's gone. Like starting in May, things are starting to go back to normal as far as evictions and things like that. It just depends on the circumstance. But so a lot of landlords are either getting out of the market, they're just done. They're like, why do I want to deal with this? I can go invest out of state and have better returns. Or even if the returns aren't better, I still have to deal with rent control. You also have it where inventory is low for tenants because people aren't moving because rents are low and there's an eviction moratorium because there's a rent freeze, that sort of deal. So I think for investors to buy multifamily, they have to think long and hard and they have to calculate the risk going into it.
Right.
We see a lot of 2 to 4 units where they're being priced as if all the units were getting market rents. But no joke, I'm seeing 2 bedrooms that are being rented out for like $800 a month in
No
LA,
kidding. Really?
right? Because people didn't keep up with the rents and raising rents. So if you're an investor and they look at this multifamily, they're like, look, I have to assume they don't move out. Because why would they? They're paying $800 a month.
Right.
Where are they going to go? So I have to offer accordingly. Oh, by the way, interest rates have gone up. I got to do another price reduction because the margins have to work. So I think for we'll call them owner users, people who are buying a house just for themselves, I think the market's going to still continue to be aggressive, like price, gains, not necessarily the 10 or 15% that we saw. Some of the data I'm seeing for LA County is looking at about 6 to 7% over the next year.
Still a lot, right?
It is, but if you take a look at the last 5 years, we've seen price gains of over 8%.
Right.
And then Ventura County is skyrocketing. It's like 11.25% is what MBS Highway. It's a mortgage-backed securities company that tracks a lot of data, and they're anticipating an over 11% gain in Ventura County, which makes sense because a $1 million house in Simi Valley is going to be, over 2,000 square feet, big yard, quiet neighborhoods. You wouldn't be able to get that in LA. So therefore, they're moving. There's a migration into Ventura County. and
Definitely.
property taxes are less, right? So they can arguably qualify for a little bit more.
Absolutely. Yeah.
Yeah.
Um, so that's going to be interesting dynamic in terms of what you're saying. The buyers are, pushing back. So, with the rising rates, sellers are definitely privy to the situation about the rising rates too and the lack of affordability. Do you think that sellers' expectations right now are just are a couple months behind of what it should be, or what do you think? Do you think that they're going to come to grips with this new fact?
Well, look, there's two reasons why a home doesn't sell. It's either because you have a bad agent who's not doing a good job, or it's the price. So, I've had some sellers where I was like, look, we can list it at X price. It's high, but we're going to know in the first 2 weeks, first 30 days, if we need to drop the price.
Hmm.
We'll know. So there are some sellers out there who are willing to push the envelope, but I do think that with the rising interest rates, it is going to play a factor. Because I remember last year I sold a house where I was like, look, I think you should list for 999, let the market do its thing. Then literally right before we list and go on the market, my seller's like, I really want to get 1.1. Can we change it and go to 1.1? I'm like, okay. And I'll be damned, we got one offer in at 1.125.
Oh
So it
wow.
still went for
Yeah.
over asking.
Yeah.
Um, but now, if they were to approach me about that, it'd be a different conversation. It'd be like, look, in the $1 million range, which is starting to become a norm, here's the buyer demographics. We have to be cognizant of that,
Yeah.
especially if there's an appraisal contingency.
Exactly.
We
Yeah.
have to play that dance.
Yeah. Appraisal gaps they're definitely real things. Absolutely.
Mm-hmm. Yeah. So, but yeah, I do think, generally speaking, I think the market's going to be healthy. I just think there's going to be a slowdown, which is what you and I have been talking about for like the last year.
Right. And in terms of the economy too, the inversion of the yield curve, which is basically that the long-term outlook on the economy is bad, is basically what it comes down to. And the unemployment rate is basically at the lowest, in a number of years, are two indications that, a recession is coming, as well. So those statistics are pretty in all the textbooks for the economy. It doesn't, it is what it is at this point. But how that affects mortgages and like we've been talking about, it's probably not going to affect prices. Um,
There's
it
been studies, the last 5 recessions, if you want to include COVID-6, only twice has there been housing price reductions.
right,
One
which is
was
counterintuitive,
2008
right?
because of bad loans. The other one was in the 90s and it was less than 2%.
Yeah, you wouldn't think that would be the case, but if there's one thing that we keep a lot of data on is money, that's for sure. So,
Yeah.
the data doesn't lie. Absolutely.
I mean, think about it. If you own a home, the market prices are going down and you don't have to sell, why sell? You wait
Right.
it out, right? It's a paper loss, but that's about it. Because you have to have a roof over your head. So what are you going to do? Sell and then go rent? Well, that doesn't make sense. For every month that you stay in your home means more you're going to net when you sell eventually.
And on a same note too, it's not like '08 where you had people who were both underwater, like you're saying, it's a paper underwater, but they also didn't have the cash flow to support that payment either. So
Mm-hmm.
because of the constrictions and then the added Dodd-Frank Act and all those things, it people are highly qualified who are buying. Like they're not getting things that they haven't proven that they can afford. And that's a real big difference too.
Right. I think that's a very good point.
I know you wanted to touch on a few things, Rick, because I think, to be honest with you, all the questions I think I came up for you, I think you've already answered. Yeah, indirectly through our conversations.
Yeah, so there's really three topics that I wanted to touch base on. First is what should first time home buyers be doing? I have my thoughts from the investment sales side, but from a mortgage perspective, what should first time home buyers, because they're ultimately the ones that are getting hit the most.
Yeah, that's a really great question, and the first thing is like like we reiterated before, like waiting is probably not good. And it's just like about life, right? You can't know where you want to go until you know where you are. Getting pre-approved is complimentary. The only thing that may really just, that if you don't want your credit run, like that's not really an issue. It won't lower your credit score if you run it once to see what you're pre-approved for. And knowing that number is key because that number may be a lot higher than you think. It may be a lot lower what you think, but without knowing, you don't know which way is north, south, east, or west, right? Um, like we said before, I don't think waiting is a good strategy in this particular market. I'm not sure if it's really good in any particular market, to be honest with you. But you know, there's no like there's a perceptual issue too. Maybe getting a gift is like we touched on before, is not something that people prefer to do. But like I said, there's no shame in it. People do it all the time. It happens. Co-signers happen all the time, and it's because not that you're financially unsound. It's yeah, you were we're in a pretty tough economic time where things are very, very expensive. That's my 2 cents.
And something else to think about, and I've had clients do this. They're like, look, I'm not keeping my house for more than 5 or 7 years. Therefore, I might as well do a 5-1 ARM,
Yeah, that too.
which is
Absolutely.
an adjustable rate mortgage, but it's fixed at a lower rate than a traditional fixed rate for 5 years or 7 years. So if you know you're going to sell within that time frame, then you might as well do a 5-1 ARM.
Yeah, arms have increased
Yeah,
on the recent
which makes
reports
total sense.
for the exact same reason. Exactly. Yeah. On average, Americans move every 7 years, so that is a viable option. I know plenty of people who basically are within that statistic. Um, I'm sure you do too, right? Past clients, things like that.
Yeah. You generally see it at the higher net worth level for the adjustable rate mortgages. I don't know if it's because of the down payment amount. Normally it's 20% or more, or honestly, their financial position is maybe a little bit stronger, so they can take the perceived risk if interest rates go up.
Yeah, I think it's a personality issue too. Like people
Mhm.
who are more, risk averse probably don't like that.
I've always done
Um,
fixed rates. I haven't done an adjustable rate yet.
Totally. I mean, same thing. Yeah, I don't like uncertainty. People who are, like you said, more financially like savvy are more inclined to go into those waters. If you're a first time home buyer, that's a conversation to have. Another conversation to have too is buying down points. Like if
Mhm.
you know you want to be there for X amount of time, there is break even numbers that we can provide that say, hey, you paying 5,000 on points by year 3.5, you're going to start making money. You those points will be paying back itself. So it's a really simple calculus, and that can be done. So that's not another option too to make it more affordable.
So thinking creatively, if because interest rates have gone up, it'd be interesting to approach a seller and say, look, seller, because interest rates have gone up, I can't afford to buy this house. So here are your two options. You can lower the price to where the numbers make sense. Might be 50,000, might be 100,000, or you buy me a point
Yeah,
for 3 or 4,000.
with the seller credit.
Yeah, because really what people need to understand is it's not about the price of the property, it's about the monthly payments. Just like cars, right? It's I don't really care how much I spend on a car. I care about the payments. Same
Exactly.
with right because it's either that or you're paying rent on a month to month basis, right? All our bills we get paid on a month to month basis. So that might be an interesting strategy, and there might be a seller out there. I know I would do it if it's like, hey, if I'm not getting my price, I'd be like, okay, fine, I'll pay you $3,000 or $4,000 if it means I don't have to take a $50,000 price reduction.
And that's really smart because across disciplines, even in nature, right? It doesn't like it's like a bathtub. Like it doesn't matter how much water you have in a bathtub. It matters how much water is coming out of the faucet and how much is coming in the sink,
Mm-hmm.
right? That principle happens across nature, across manufacturing plants, and like, even along loans. Cash flow across businesses is most important. And
Right.
cash flow, like you're saying, is making more that you have more cash coming in than going out is more important than, like you said, how much water do you have in total? Doesn't matter how much water I have. It matters how much cash is coming in, how much cash is going out.
Yeah. No, I agree. So I think, for first time home buyers, especially, I mean, as you know, and we've worked with clients on this, it's all about house hacking, right? It's buying a property and renting out another unit. It's buying a property and getting roommates. And not everyone's game for it, right? It's not for everyone. Not everybody wants a tenant living on their property. But also, if you need to get into it, you need to get into it. I'll tell you, I have a studio ADU, accessory dwelling unit, amazing tenants. They pay on time because we do a lot of vetting. I don't see them. I don't hear from them. Really, my lifestyle is no different other than I don't have a garage. And then I looked over my most recent mortgage statement. They're paying the interest, an equivalent of the interest on my loan.
Wow. Yeah, that's
So
great.
even though, yeah, I'm not living for free, I effectively have a free loan. I have a free
Exactly.
mortgage.
100%. And
So I,
every payment you make is going to go into your principal.
right. So using that logic, even if I go to sell my property, it's like I got a free loan, which means I effectively netted more.
Right.
And so I think it's all about that mindset, and people need to also understand, like, it's not forever, right? You don't have to have a roommate forever. When I bought my condo and had a roommate, I didn't want a roommate forever. I helped him buy a place. Once he moved out, I didn't get another roommate. Why? Because my wage had gone up. I can afford it at the time. So it doesn't have to be forever. And I think that it's just a matter of getting that creativity going to get you into the game.
And on touching on that subject too, the biggest first time homebuyer mistake is basically what you're alluding to, which I think it is that you got to treat it as a business, your personal finances. If you treat it as an investment, what does it make sense? Am I going to have more money coming in than going out? Versus, oh my gosh, I really love the shutters on this house, or I love the black pool bottom,
Yeah.
right? That can really cloud your judgment. And first time home buyers, it's not going to be your first home. You're going to upgrade as time goes on.
Right. I think maybe that's part of it, right? People buy a house thinking, I'm going to live here forever. And like, you're not. You don't have to if you don't want to, right? Like, and I think because people like that flexibility with renting, right? That's kind of the argument. It's like, give my 30-day notice and I can move. So it's like, okay, well, if I lived in my house for a couple of years, I give my realtor 60-day notice.
Right.
And then I get some tax-free money. And then I move. That doesn't
Absolutely.
sound so bad to me.
Yeah. The personal, attachment, that really clouds a lot of judgment for sure.
Yeah.
And
So I
not
think,
only
I think
that,
that's
keeping up with the
hard.
Joneses, that clouds, especially in LA, is I think it's almost like a sickness. It's not whatever home you buy is your home. It may not be in the best neighborhood. You shouldn't don't compare with
Right.
someone else that you went to high school with who's your same age. you know, it doesn't matter in the grand scheme of things. Nobody should care about the home that you decide to live in at this moment in time. People, have different situations. You know,
Oh,
uh, yeah, that's a problem. I think a societal problem that we have, and that's something that should not be a factor.
I 100% agree. So I had a conversation with some friends who live on the West Side. One lives in like Mar Vista, one lives in Santa Monica, and we're all talking about hanging out sometime. And they're like, well, we're on the West Side, but then you have Rick who lives in the Valley. And I
Yeah,
was like, I want to get something straight. You're renting on the West Side. I'm owning in the Valley.
right.
Very different. And then when I told them how much my portion of the mortgage is and how I'm paying less than what they're paying in rent and I own, they've never brought it up since.
Yeah, that's a really yeah. That's it, it's really unhealthy for everyone involved in society in general to have that kind of mentality.
Right. Yeah. And, one of the things we were talking about is, are we going to see less buyers out there? And I think that there's two different types of buyers that we're not going to see. You are going to have those buyers that were at the bottom of the price points that literally just got priced out. Like there isn't another neighborhood for them to move to
Hmm.
unless they move out of county, which some can't do because of work. There's those people. Then you also have the fear side of things, right? People who are just scared. Oh, interest rates are up. Home prices are up. Should I really buy? These are the same people I had conversations with years ago, right? So a lot of the ones that I'm seeing that are more fear-based are not going to buy no matter what the market's like.
Yeah.
Right. I mean, that's really what it is. Because I had people 2 years ago saying, no, we've topped out in the market and everyone's telling me there's going to be a bubble. I'm waiting for it. Right. And here we
Right.
are 2 years later, and now they're priced out of their own neighborhoods. It's like you had your chance.
Yeah, and I think, the problem today too is like, there's always marketing scams and schemes and, sometimes like the advice you give, Rick, like we were talking about this the other day, like sellers didn't take your advice and they paid dearly for it,
Mm-hmm.
because they think that maybe there's an angle you're trying to come up with. But I would say in the majority of times, people are giving you what they think is best for you. There's a fiduciary responsibility to a client
Right.
to what we're talking about, like this is what we think is going to happen. We don't know. Like if
Sure.
we knew, we would be billionaires.
Be
Um,
playing the lotto.
exactly, exactly.
No, I agree. But real estate in general is still one of the lowest risks investments because it's a basic necessity. You have to have a roof over your head.
Absolutely. It's not Bitcoin.
Yeah. Right. Okay, so let's go into what's going on in the news. So what's been going, so it's been going on for the last couple of years, but there's been more judgments coming up in recent news about there's a group of sellers that are suing the big real estate companies, Keller Williams, Realogy, which owns a bunch of different real estate companies, and Remax, about the sellers basically are pissed that they've been having to pay buyer side commissions, which their arguments are it's inflating their costs and they're basically paying someone to negotiate against them, right? It'd be like me in the courtroom paying for the defense's attorney. So, what are your thoughts on that? And then I'll go into my thoughts.
Yeah, I think it would be a real bad idea. Because basically what happens on an escrow master settlement is they list every line item of the costs associated with a transaction, right? And the commission for listing in buyer's agent is going to be on the seller side. Why is that good? Because first time home buyers or anybody who's buying has a sum of cash. Now, I don't care if you're Bill Gates, you reach a constraint, one of the two. It's either income or cash. A lot of first time home buyers, it's going to be cash because a lot of millennials have pretty good jobs, right? But they're paying so much rent, they can't save anything. Um, you're going to knock out a lot of people who, in the American dream, owning as a home is a fundamental part of that. You're going to knock a lot of those people out because you have to come in with extra cash when they don't have enough anyways. So I think that's going to be a societal, problem. And it's going to make it more expensive for buyers because ultimately the seller is selling not because they're losing money, they're selling to gain a net profit, a net proceed, usually to put onto the next house. And guess what? If you're going to buy on the next house, you're not paying the commission on that side because you're on the buy
That's
side
fair.
anyways. So it all works out, right?
That's a good
So
point. It's almost like it's a wash depending on the price point.
100%, 100%. And your price point is more than likely going to be higher than the one you're selling at. So you're
Sure.
actually making probably a more of a net.
That's a valid point. So I think there's another way to look at it, and then we go into the different scenarios is really is the seller paying commissions? And it comes out of their net proceeds, but then that cash has to come from somewhere. It's coming from the buyers. So effectively, the buyers are paying the commissions indirectly. And then on top of that, they're able to finance that, right? Because it's all through the mortgage, which means, so let's say we eliminated buyer side commissions from the sellers, right? But if me representing a buyer, I got to get paid. So how am I going to get paid? Well, the buyer could pay me, which could be a problem because you're right. There's cash constraints. So then it either forces two things to happen. One, the buyer is going to have to offer so low of a price on the seller side that it compensates for the down payment, especially for first-time home buyers. If they're putting 3.5% down, they have to put they have to offer so low that the 3.5% down payment difference is enough to pay their agent.
Absolutely.
Or it's going to start going into what's called dual agency, where the listing agent is going to start representing both sides, which I've done before. It's been fine. But the two downsides are, one, now the agent is basically neutral. Because now they argue they have a fiduciary responsibility to both parties. So they can't give one advice over the other. So no one has their own representation. So you could argue that if you're a seller, you actually want to pay a buyer side commission. You want them to have their own representation. I had a seller, she was an attorney. She did not want me representing the buy side. She's like, I want you to represent me and only me. I said, fine, makes sense to me. But now we're basically promoting dual agency. The second issue is in California, we have dual agency, but not all states allow it. So
for good reason too. Yeah.
It actually is one of those like good reasons. Like it makes sense. But if sellers aren't going to be paying those commissions, the buyers can't afford it. Now what?
Now what exactly?
So that's where I think it's kind of ridiculous because buyers are going to want a discount. They're going to come in and say, look, you no longer have to pay this fee that all these other comps did have to pay.
Mm-hmm.
Therefore, I want a discount. That's why for sale by owner homes, historically have not sold for more than what it would with a realtor. It ends up being about that same discount.
Interesting. Okay.
But go ahead and add on all the liability. Right? Because buyers are expecting the same discount. They're like, I'm doing for sale by owner. I'm not including agents because I want that same discount you're getting.
Right. Yeah. It doesn't. I mean, it's worked this way for a very long time. I don't suspect that it should work any differently.
Certainly find out.
Yeah.
We'll monitor it and we'll talk about it at the next quarterly meeting.
For sure.
And then the last thing that isn't necessarily in the news, but we've been seeing more and more homes go on the market with solar panels. And so I have a lot of buyers and sellers asking me about it. So Zillow came out with a report in 2019 that basically said on average, homes with solar panels sold for about 4% more. If you look at their data, they said in Los Angeles, it was about 3.6% more. So does it really add value? Well, according to Zillow, it does, except we know that the cost of adding a solar panel is like 30 grand. So in order for a seller to make money on it, wouldn't the home have to sell for like $1 million or more?
Right.
So if you have a home in the $800,000 range, you're actually losing money by adding solar panels.
Right. Yeah. In terms of the loan side, like anytime I hear there's solar panels, I kind of like, I shiver. I give a shiver because it can be a problem sometimes. And the reason why is usually because of if it's leased, because we're on timeline constraints, and then if there's a leased solar panel, basically when the buyer assumes that, they have to put it, the solar panel company has to put it in second position behind your mortgage, and they don't care about your timelines in the contract. It can cause a problem in terms of closing on time. I haven't seen an issue where they haven't subordinated. Really, it's just a matter of we're just waiting. It's not it's just not conducive to the timeline.
Yeah, and look, there are personal financial benefits to solar panels for some, right? The whole point is to eliminate your electricity costs. So I'm not knocking on solar panels. We're just talking from like a resale perspective. In my experience, and I haven't done a ton with solar panels, but I have represented buyers and sellers with solar panels. And so far, my experience is it hasn't changed anything. It helps with marketability if it's paid off. That's like a big thing. If it's paid off and there's two houses that are the same, the one with solar panels will win. But I've never had a client say, I'm willing to pay a premium for solar panels. I've never had that in my experience. And I think a lot of it has to do with LA being such a high-priced market to begin with. Buyers can't be picky, nor can they afford to pay a premium for something like that.
Right. And, I don't feel like utilities are really ever factored in, like on a pre-approval, right?
Mm-hmm.
I've never heard anybody ever say to me, oh, but how much are, water and electricity going to be? It's never been a question, I've never heard that question come up before. So I think you're right. It's not something that's important when it comes to picking the property.
Yeah, the only I agree. Rarely do I have I have had clients who've asked. They primarily ask if there's solar panels because like, are there really savings? Um, or if there's some special circumstance, like if you're up in like Malibu or in the hills and there's like a water tank, they're like, okay, what do those bills look like? Something that's not normal. But you're right. People don't really think about furnishing a place. They don't think about the utility. So like, I want a big house. But do you know how expensive it is to have a big house?
Yeah.
Do you really want a big house? Oh my God, this backyard's amazing. Look at all these trees and all these plants. Do you know how much it costs to water those plants?
Exactly.
But
Yeah.
people don't think about that. They're like, oh my God, this is gorgeous. I want it.
Vaulted ceilings. It's like heat sink up there, you know?
Right. So those are all different things to think about. So it will be interesting, I think. And also, I don't know if you've noticed on appraisals, on the few appraisals I've seen where there were solar panels, 100% of the time, appraisers have not given any value for the solar panels.
Yeah, and I think it'd be in terms of what an appraiser's thinking. I mean, I'm not an appraiser, but what I have
Sure.
to imagine is that, what, like, let's say the price is like 850, right?
Mhm.
What you're going to do is you're the more than likely, if I was an appraiser, I would put it at 850, or it's not worth 850, put it below. But I probably wouldn't ever go above because you're sticking your neck out for the most part, I would say, to try to justify a value that the house is undervalued in terms of the purchase price. Um, I have to. They're a highly regulated part of the industry now too, so they try to be as cautious and as conservative as loan officers are too. So yeah, I agree with you. I don't think that it makes that much of a difference.
Right. All right. So as we wrap this up, if you had to sum up what's been going on over the last quarter and what you kind of foresee going forward in like one sentence, what would you say?
Uh,
I know I just threw this out
yeah.
there.
I would say, it's gonna get more expensive. That's at the end of the day. It's this waiting is not in your favor.
Yeah. And I would say interest rates are going up. So we're going to see a slower market, but inventory is still low. And that's going to keep prices keep going up. It's all about the inventory.
Definitely.
So, all right, John, as always, thank you so much for doing this. How can people get a hold of you?
Always available. My cell phone 818-805-4238. Text, phone, anytime.
Nice. And if anyone wants to get a hold of me, you can follow me on major social media platforms such as Instagram at Rick B. Albert, or feel free to give me a call or shoot me a text, 323-929-7653. Thank you so much, John, for everything that you're doing. And I'll talk to you soon.
Great job, Rick.
Thanks. You too. Bye.